And we're live. All right. Hello, everyone, and welcome back to Crypto Oracles. So in today's video, our plan is to discuss what just happened in the Fed meeting. We're going to discuss the press conference and some of the questions that we noted down for you. Just going to go through exactly what's happening and what is, what does the rate increase mean and how is the market going to react. So for the ones that don't know, what happened today is that the Federal Reserve announced a 0.25% interest rate hike. And this is the first increase in 2018. And they also forecast 6 additional increases this year, so it's going to be a total of 7. And these, the aim of the increases in rate hikes is basically to make borrowing more expensive, so that consumers and businesses hold off on making any investments, thereby cooling off the demand and bringing prices back in check. So we basically just want to bring prices back in check. We want to have some price stability, right? So that's the main point of this meeting. That was the main point. So the main points I'm going to cover, and then we're going to go through everything, are the following. So the outcome of the meeting was that the economy is flourishing and should flourish in tighter policies. We are going to slow down demand to give supply time to recover, which is great. There is a very strong economy and good momentum in the labor market that we're going to touch on. It's time to begin to shrink the balance sheets. That was another of the main points, and some people can see this as another possible rate hike. And the committee is very clear on returning to price stability and achieve price stability. So these are the main points, and then we can comment on this. What do you think? Well, you've seen the video, you've seen the live with me. What are your thoughts on this?
Yeah, I think the main expectation for the markets was in general understand the approach of the Fed, how strong they want to bring down inflation, if they were actually prioritizing the health of the markets, or if they were just prioritizing bringing down inflation, so even causing a recession itself. And yeah, we will discuss now the actual approach, which looks like they don't want to cause the recession itself. They just want to bring price stability and rate hike slowly. So yeah, the big question was, is it going to be 0.25? Is it going to be 0.5? And I think the 0.25 was already priced in, which is good. And if in the case we saw 0.5, maybe we could have seen more pain on the markets, but this wasn't the case. So we could see even a good bounce in the market or just keep ranging. So probably not dump more.
Yeah, I think this was one of the main points as well during the meeting, right? Most of this is priced in. The current hike is priced in, 0.25 was priced in. So people that don't know, the rate hikes we were expecting were either 0.25 up to 0.5. 0.25 is the lowest range. So pretty good after all, and pretty expected. And then we're going to take a look at the charts in a moment. Should I go through some of the points then? So the first one that I want to touch on was the labor market. So we made a little summary for you guys. So what was said during the meeting just 30 minutes ago was that there is currently 1.7 job openings for every unemployed person. So it's a very, very tight labor market. Companies are having issues hiring, and this is creating a lot of pressure. So the aim of the interest rate restricting the hiking interest rates is to basically create a much slower demand, and this will give enough time for the supply to recover, and this should eventually bring inflation down, right? So without the price stability, we cannot really have a long period of sustainable employment. So what this means is that we have a strong labor market, but employers are having a lot of challenges hiring new people. And the way to go about this is to slow down the demand to give supply enough time to recover. You got any comments on your side on this?
Yeah. I think that the main point we're just saying that the economy is very strong, the labor market is very strong, and the economy would be probably able to get these the consequence of the rate hikes without causing a recession or anything too bad. But yeah, a consideration that we'll do is like this system is strong and healthy at the moment because it's just coming out these favorable times or monetary expansion, easy credit, and things can turn south very fast. So yeah, it's true that the economy is very strong. It would be like all the metrics are good, but then things could go south very fast. So yeah, I'm not so sure the Fed will be able to actually do 7 rate hikes in a year, probably like 4 or 5 and then
Yeah, I
in
think
case they get to unsustainable
this
level, they
is
just pivot back into monetary expansion that they always did.
yeah, this is one of the points that they kind of said, right? They said these are just planned meetings. There is no schedule on when they're going to happen, how fast they're going to happen, and they don't know it themselves. That's pretty much what I got from what they were saying, right? So it could be 7, it could be in the year, they could be 4 of them right away, and then 3 later on. There is no clear, plan, and definitely not clear pace. Actually, on this, I think one question that was asked during the meeting was that kind of relates to what you were saying. When will inflation come down, and how will you signal that? And I can really answer for everybody listening in, and then we can give some comments. But so the answer was, before the Russian invasion, the Fed was expecting inflation to peak in the end of the first quarter of 2022 and to come down in the second quarter. Now, because of Russian invasion, which caused higher prices of commodities, higher prices of oil in the US, we are seeing an uptick in inflation. So inflation is actually being pushed higher. And plus, we're seeing a lot of stress on the supply chain issues around shipping, for example. So this could push basically forward the relief intended by these hikes. But still, the Fed said that their idea is that we're going to start seeing the results of the hikes by the second half of this year, and they want to bring neutral interest by the end of the year. Now, yeah, I think my take on this was that it is true. The Ukraine war has some effect. At the same time, there was been a couple of conflicting points. One of them was the fact that they were saying, rate hikes take a long time to have an effect on the economy, and that's true. Absolutely, it's not something you see today. And the other one was markets have priced in the rate hike, at least the first one, and that's also true. They priced it in. At the same point, I'm kind of wondering, asking myself, aren't the 2 points conflicting? Of course, we're talking about the markets on one side and the long-term economy and macroeconomy on the other one. So probably they not really that conflicting, but still interesting view. What do you think of that?
Yeah, I think the Fed's prediction and in general, US prediction on inflation have not been very accurate for the last 1.5 years. They were predicting first at maybe at most 4%, and there were no, actually 2.5%, 3%, and then they were saying it was transitory, and then we've seen that for the last 12, it's just been going up and up, and it's not transitory,
Yeah.
and it definitely went higher than all the prediction that the people jobs were actually just predict that, and they got it wrong for like 3 months in a row. And plus, now there's another, let's say, black swan event, which is the Ukraine war. So yeah, inflation is running hot, and it's probably not transitory. It's not going to come down very soon. We see wheat prices going up like 50%, and yeah, we know that Russia and Ukraine are like 1/3 of wheat production exporters in the world, and then like probably 80% of sunflower oil.
Yeah,
So
that was one of the big
inflation
ones.
is gonna run very high. Like all these type of commodities are gonna increase spending, like cost of production. We see China going in another outbreak, which means like they have zero COVID policy. It's not as bad for the cases of people dying, but they have a zero COVID policy. So there will be another like supply shock from China as well. So yeah, I think for the economy itself, I know it's very strong, but then we have to deal with this crazy inflation, these supply shocks. We won't be transitory. So I don't really see inflation coming down as very fast, probably. Hopefully at the end of the year, but then
Yeah, I definitely agree. I mean, it's a fun thing I was thinking about the other day, related to this, which is imagining if you're buying wheat or sunflower oil, for example, right? So the price of some of these goods, just normal goods, kind of double or triple, right? And then on top of that, you're gonna start thinking that the price of oil in the United States more than doubled, and same in Europe, right? So imagining all the trucks and the suppliers that are actually carrying those goods using mainly trucks, and across Europe, I think more than 60% of transport is just petrol based transport. So imagine you double the price of oil, you double the price of gas, and you double the price of petrol, and on top of that, you also double the price of what you're transporting. It's definitely going to see an increase in price, and it's going to have a strong effect on inflation as well.
yeah,
On
one
this,
last thing,
yeah, go ahead.
like Yeah, my consideration, they were talking about demand being too high for supply, but then the problem they're trying to bring down demand. But the problem we've been having here, the even basic goods, we're having like all the types of supply shocks, supply problems. So like even countries not being able to refurnish the oil, country in the Middle East that brought well problem with these wheat high prices. So these type of goods are goods that the actual normal person needs to have. So I see more like all this inflation is driven by the supply side. So I understand the Feds are trying to bring down the demand side, but the way the situation is going, recession is definitely on the card. Yeah.
Yeah, I think on this point, interesting question that got asked during the meeting was about GDPR, so the United States GDPR, right? So what they were saying was we're seeing an increase of GDPR from 2 to 2.8%. So a growth 2 to 2.8. 2% last year was the growth, 2.8% this year, so very small increase year to year. How much of that is due to the policies, right? That was the question. So, and the response was that there was some early assesses of spillovers from Eastern Europe. So basically what they're saying is that, we're already starting to see some of the effects of what we talk about now. And they will basically say that these higher commodities will definitely have an impact on GDPR. It's unlikely to be due to rate hikes, as these have delays, right? And so the rate hikes are probably not going to affect GDPR GDP for a long time, and even if it was less than last year, even if it was less than expected, it wasn't that far off. It was still a 2.8% increase year to year of GDPR, which is not bad. Last year was 5.8. So interesting question, interesting point on the macroeconomy of the country and how are rate hikes going to affect the country, plus how is the whole Ukraine story going to affect the country.
Yeah. One of the observation I would say is that many have this observation that Feds are actually very late in the cycle at tightening rates. So it's true that the economy is very strong at the moment, but it's actually is slowing down right now. So it would be much better to actually start hiking rates way before. So Fed was still like purchasing bonds and assets on the balance sheet when inflation was like 7%, which is crazy. Anyway, in general, we see now growth slowing down. GDP is not that strong anymore, and Fed still need to hike rates. So that was one of the main observation. The hiking rates probably at the worst time, but they don't really have any other solution. I think the market is doing a lot of work for them. Like already bond yield already very high, because in this type of inflation, like you don't want to hold the bond with negative yielding. So the economy is already doing most of the work. They just need to
Good point.
do.
A point on that, actually, kind of linking to what you just said, was one of the questions was how much inflation has come down as a result of the rate hikes so far, right? So the answer to that was that really rate hikes are delayed, so you're not going to see much of that now. We are seeing a shift in the market simply because most of this is priced in. But then the answer was the current lowering of inflation so far is mostly coming from not from rate hikes, but rather from the supply chain relief. And they're basically looking for this to come down month by month and reassess the situation over time. One of the things that they are opting for and looking towards is a shift from goods to services. And the last thing they mentioned was that these policies will start to actually bite inflation with a lag. So we're going to see the effect of the policies maybe in 23 and 24. And they kind of reiterated on the strength of the economy overall.
I think some of the great chart that we looked at in the last live was showing that in general, from the first rate hike, you see a very big correction at the beginning, but then throughout the actually hiking itself, with the usually last like a year or two or even more, you can see that the market is actually very wealthy, even increasing. This is actually in a bull market. You see the actual decline as soon the consequences as soon as the hiking process finishes. And yeah, most of the big recession came as soon as this process finished, and it finishes because the economy just starts going south, and Feds have to pivot the other way. So yeah, that's pretty much it. Yeah, I think now the situation is very different. So I don't know. It's always how long can they do it. So I think right now it is not. I wouldn't probably see. I don't think probably see any too much pain in the short term. I mean, probably like we hold time on stocks, so the correction is already happening. It might keep going. But for example, in Bitcoin or other assets, they're already very strong on chain fundamentals that you can see we're really near the bottom. I don't see too much pain. We can go a tiny bit more down, maybe. Yeah, as I was saying, like probably the end of this tightening cycle, we probably finish with like a kind of liquidity crisis, like every asset selling off, lots of pain. When you see that kind of fear, and then yeah, then people panicking, having to sell because everyone wants to sell, whatever. That's the moment that everything is going to pivot. So once you see that happening, that's probably when we actually see the true bottom. But we're very close to it.
Yeah, I think I was going to bring this up as we did last time, and kind of, I think where we are now, we are consolidating, and this consolidation phase that we just seen now, it's basically this anger towards depression phase, and I mean, nobody can really tell where we are. I mean, this is just a cheat sheet, so this is more of an indication, but this is a classic cycle, right, in the market. And we are somewhere down here. We are somewhere down here at this point. This is where you want to be interested in the space. So we're going to take a look at the charts in a moment. Last question that I thought was a couple of last questions worth mentioning. One of them was just a comment. I found kind of very catchy. So it said, last time CPI inflation was this high, 7.9%. The rate hike was 19.72% in 1981. So today's rate hike was 0.25%, right? So I thought that was an interesting, the guy asking the question was kind of biting off Jay Pavel, and there was a bit of an interesting question. I don't think he gave a direct response to that, but definitely in the past we've seen much stronger rate hikes than what we're seeing now.
Yeah. I think in general we are seeing it's a very unprecedented time. So like Fed's funds rate at zero, inflation so high, unemployment so low altogether. It's it never happened before. So it's really hard to look back in history and see a very similar example. So that's why there's also so much uncertainty in the market.
Agreed. Should we take a look at the charts, or you want to ask a couple more questions? But I think we probably already discuss every point we want to discuss.
No, don't worry. I think tomorrow we'll probably discuss more macro with the risk oracle. So if you're interested.
I mean, yeah, guys, if you're following on this now, there is going to be another live tomorrow. You're going to talk about, I guess you're going to talk about some of the more macroeconomic, economic scale, and discuss kind of the economic outlook today. Is that the idea?
Yeah. The idea is talk about the macro outlook in general. So what's happening, more like zoom out and see the economic situation of these last 100 years and what Bro has here, like this sovereign debt bubble, and also talk about macro concept like yield curve inversion. What does it mean? And all the things happening in the commodity markets and so on.
Right.
We still need to write the agenda, but we'll let you know soon.
Looking
tomorrow.
forward.
Don't forget to follow us on Twitter. We post all our updates, and definitely on YouTube.